Good morning, SMF MMTs, apprenticeships that you are been learning a lot about the Dow and about indexes and sector indices, economic analysis, all forecasted before the fact, before the moves would occur. There had to be a reason why within the price volatility structure from day to day. But where was that forward-looking area going to happen? We're going to talk about this wonderful little chart right here called the Dow Jones. And unlike the Dow Jones, it's flirting with its 200-day moving average with the daily bear signal, sell signal. And that you can clearly see when the rally started over here and when they made their double top, and you're coming right back to the lows where the summer rally originally occurred in June. And we are testing that 200-day moving average, long-term bull 200-day rising moving average is coming into play. Now, just as a reference, I will show a chart on the S&P 500 here where the S&P 500 has undercut its 200-day long-term moving averages where things have bounced and done well. But I'm sorry, you're below it. And it's the first time of the year where it took this magnitude of selling day after day after day after day. And there was your little rally. But look at here on the S&P. This is a long-term constructive neckline on the S&P. But let's get back to the Dow with the daily sell signal. Now, MMTs, when we look at this Dow, it's going to flirt with its 200-day moving average 1 day, 2 days, kind of like the S&P did. And we have dropped to the psychological level of 12,000. The thing about it is, in the short term, MMTs, when we were up here, we were at 93.43% DS overbought. We pulled back. I said there's going to be a correction again, and darn sure is correct about it. Go to stockmarketfunding.com. You can find it all there. Up here at the peak of 74%, which wasn't quite as overbought there, is that we have finally hit the 77% DS here, which is a public standard indicator that people use in the bigger world of money. But now we're getting down to 16.16%. on the test of that 200-day moving average. And the thing about it is, outside of with all the volatility and all the pessimistic things that are going on, and rightfully so, is that what do you do in the short term with volatility? If we break below here, the lower that we break below it, we're going to hit a area after the unemployment number comes out Friday. We're going to get oversold. And that the current macro environment of the news is being built in with an oversold market, because then you get some upside volatility. But because we have the daily sell signal, the reason why we keep selling short into everything is that the Dow is flirting with its disaster. And that volume will be light until Friday when the unemployment number comes out. What will end up happening before the fact now, this is all before the fact, is that the market right now, this Dow, 1, 2, 3, 4, 5, 6, 7, 8 days down in a row. You haven't seen that since the financial crisis in 2008 is when you would have to go back to that. And volatility up, and downside volatility short, and short term, people will be looking around the world as to how oversold in the shorter time frame that the market is, and that the jobs report on Friday, as bad as it will be, is pricing it in. So when Friday comes around and it's a bad number, that's when you look for upside volatility pops and then sell into the news short again. That's how the jobs number relative to the Dow number here is going to play out. Okay, if we break below the 200-day, more selling will increase. The debt limit is out of the way. The little funny bunny packages that Congress has done has passed us by, and that equities have sold down, that U.S. GDP that we said, the PMI, the ISM indexes, and all of that, what started that rally over there, that those numbers were not true, and that it would come back and haunt this rally, and that lower growth was what we were about, and all the economists, 3-4% year-end, second half, they just downgraded to the third quarter. The ghost quarter is the fourth. Ha ha ha. But let me tell you something. Contraction in growth and consumer spending does not bode well. If Mr. Bernanke, the Federal Reserve, comes out and does another QE3, you thought you were paying a lot of money for a loaf of bread? Forget about it. You thought you were paying money high at the gasoline pump? No, you haven't seen nothing yet. That is if the Fed tries to come and pull its little shenanigan again that drove commodities to all-time highs in 2011 and gasoline futures to all-time highs in 2011 by repeating that process again. By repeating that process again, we would be looking at the 30-year bond that people have a tendency of gravitating with all the financial disasters in Europe and things going on outside of the U.S. and within the U.S. little contagion, is that's where people go. But what will the Fed do is try to move that money off of there. And how do they do that? By monetizing debt in such a way, they won't even call it QE3. They'll take their balance sheet and exercise that into the system. Then what will end up happening is that other parts of the world are in trouble. The only good thing about this Dow and about U.S. equities is that the safe havens around the world are not so safe. So once again, is to bring money aboard and flush it into our economy and treasuries and various different other things. So we are, the more oversold we get, the more that these numbers and the contagion will be priced in for short-term volatility pops. Once the selling clears, as you know how we took this move here, well, we will have intraday volatility to the upside because we get very oversold. But the long-term constructive view of the Dow and other indexes is it doesn't look good, and here's why. When you take back over here where Bernanke came in and did QE2 originally a year ago in August 2010, we were down here at 9,600. They injected the stimuluses there, and off to the races we went to all-time highs from that QE2. So where did the QE2 come in? It came in over here. And what month? Well, here we were at the end of August of 2010. We put in a bottom, but that's what the QE2 did. And everyone was bullish for the whole year, as we forecasted the year, just like we're doing now for 2013. Before 2013 even is going to be here. I would stay tuned for those reports. Of course, they're going to cost you some money, but hey, they're worth having. Because if you know what we know, then we know that this whole trend from that QE2, and they're talking about QE3, will actually choke the growth further, and that the consumer spending, well, there won't be too much spending over there at Lowe's or Ross stores or Kohl's or whatever kind of those big high luxury retailers must be sold short for an extended period of time. The daily sales signal on the Dow, this is when we peaked. We have a ways to go. We undercut it. That's where we're going to look for this support line here where the rally started, see how it holds as it undercuts it. And then, of course, the all-time low which was over here on 3/16, March 16. From that first correction, the long correction, we have another correction. And that so goes the year, is that the weaker that we keep building and each rally fails, is that we will get oversold. There will be a bounce in some of the leadership names. But let us not forget that the market has changed. Slower, overheated housing markets in China. They built their infrastructure out for the last couple of years. They're going to have problem in their capital banking system. Okay? So a lot of the industrials, as we know them, and a lot of them safe haven trades that people went into that were great, well, they'll have to restart doing the math a little bit, because you got to remember that the earnings came from those regions. That risk-on trade is not here. People will get on the sideline. We're going to get more fear. We're going to take a look at where the fear indicators are. The Dow is set to break its 200-day simple moving average. The debt ceiling is out of the way. There's a new set of stimuluses behind the scene going into the Playhouse 90 book again. However, with all of these little Playhouse 90 things that Congress does and Bernanke does, they have a tendency of not working, as we can clearly see. Doesn't work. It's good for a trade for the upside. It's good for a short for us. We don't care. We could care less. I'm just letting the general people know out here that these so-called great people that were hired to watch over the capital system actually end up hurting the system. Another QE3 will knock this market, and you will have a negative GDP growth. You won't even have 1.3% when that happens. Let it be known on this very day. Forward looking, if I were you, it'll come clear to you at a later date, and I would come back and revisit the same video. Because as we set up our trade managements, because our success was here, shorting, and our success here was going long, and our success was understanding that short-term overbought and oversold cycles, price volatility has increased to levels that most people can't even deal with. We love it because that's how we make money. But your normal people are above average, even out here. They just can't stomach it. They always miss those moves, and they always start buying up here on the first pullback, and then this happens here. The daily sell signal, we'll see how far in length it goes between now and Friday, how they price in the bad news, and how markets have a way of pricing in bad news ahead of the event, and how you can trade the other side of that contagion for a quick trade and make money by understanding the core principle and the intrinsic value between overbought and oversold, and understanding the core value of markets pricing and events before they happen. They have to throw in the towel, and the thing of it is, they're coming out today downgrading the third quarter. The fourth quarter, that's the ghost quarter, because once again, it's for them, they don't like to admit the truth. And well, we deal with the truth here every day, and this is the truth. Dow Jones is about to break it. Once it does, we'll see more selling down to these support levels. The amount of selling that we have had in this period of time, which the markets have not dealt with, is a major turning point. Because that means that this is what the market has below it. And if you want to go read the Dow history, I'm telling you, this is what the market has below it. What took it up off the 2009 lows from the long-term stimuluses that went into effect to that high, you've got this much below the market. Lot to go. What took it higher? All of these expansions They never turn out. You can't even find one. And go back and look at all of our analysis. Why? Is they're good for people to invest and trade with? Sure. But how many people will know when it's over? They won't. They never do. And they have to pay a price. There's a big drop. What drove it higher can also drive it lower. So, as we approach the dog days of August, we get into September, we will have short-term rallies again from oversold conditions with leadership stocks. And the earnings were very constructive during this quarter that we're in. There was some great earnings out of IBM and Google and Apple. And technology is different than a lot of other sectors. It's like its own thing. It's got its own thing. Just to show you, the Dow's down 150 points. That S&P 500 is down 19.5 handles below its long-term constructive bull trend to a bear. Short-term bear on all of these indexes. Now, the difference is technology did not lead it down as it did in prior 2011 corrections, such as this one here was driven down by technology and seasonality and weakness. There was technology that had led the move down first. Here we're starting to see where we can get some capitulation on an intraday level, and what we will be looking for is a knife hook reversal. Rather that be late in the day or on Friday's jobs report, it'd be a good time to get that upside volatility and all that bad news that's being priced in here. Okay? And as you can see, the deterioration, as we have called this, move before the fact. And if anyone's in denial, go to stockmarketfunding.com, type in the little search box there, index, and you will get lots of live trades and analysis before the fact. Bull rally, bear rally. Bull rally, bear rally. Hey, you made a lot of money that way, and you made a lot of money that way. All is good. Dow Jones, when we start to go through that long term, it's the first time this year that we're sitting on it. The other times we got close to it was a little bit percent level above it, but now we're on it. And you've got that daily sales signal to go along with it. Short the highs intraday. Short the highs intraday. Volatility gaps, as we have said for the last 3 weeks. Sell short the news, because that news was not going to be sustainable. And the haircut is taking place here and now, and we will do a lot of sector indices. We will do a lot of the bear ETFs that are totally oversold. Been long overdue for those to go in their uptrends. How about that? So there are lots of plays. Remember, good news, bad news, any kind of news, it doesn't matter. What matters is your trade management. Your trade management short and your trade management long, using put options for failures, using call options for rallies, understanding the gift of understanding market volatility. And now we get to see the volatility work. Here. Right there. And where does that selling start to really come down? People will be on the sideline praying for that jobs report on Friday and the ADP report on Wednesday. What goes up must come down. How do I make money that way? How do I make money this way? How do I understand the market internals and then make good of it? Just because a everything else isn't going hunky-dory for Wall Street doesn't mean that you're your own Wall Street right here, right now. And everything is good here. And that's nothing but red. Look at that. Each day from the 22nd on. Trade management. Stay tuned.